Chapter 14, Installment Buying. In this objective, we'll discuss revolving charge credit cards, how to calculate finance charges on these types of accounts. The Fair Credit and Charge Card Disclosure Act of 1988. To protect consumers, Congress passed the Fair Credit and Charge Card Disclosure Act of 1988. This act requires that for direct mail application or solicitation, credit card companies must provide specific details involving all fees, grace periods, calculations of finance charges, and so forth. In 2009, the Credit Card Act was passed to provide better consumer protection in dealing with credit card companies. Interest charges are based on the interest rate stated times the previous month's balance, which is your outstanding balance. Payments are first applied towards interest and then the outstanding balance. This is the U.S. rule that we discussed in Chapter 10. A revolving charge account allows the buyer open-ended credit to purchase items up to the maximum amount that they are allowed. So for the example that we're going to work, Abby Jordan bought a dining room set for $8,000 on credit. She then has a revolving charge account at Moe's Furniture Store. She can make as many purchases on credit as she wants until she reaches her $10,000 credit limit. Oftentimes, customers do not pay their revolving charge accounts at the end of a billing period. When this occurs, stores add interest charges to the customer's bills. Moe's Furniture Store calculates interest using the unpaid balance method. The annual interest rate is 18%, so they're charging 1.5% on the previous month's balance. This is a really great little chart to look at, and I'm going to get on the soapbox for a minute and lecture you guys. The costs in years and dollars of paying the minimum 2% of balance on credit cards with an annual interest rate of 17%. So if you go out and you go on a giant shopping spree and spend $1,000 on new clothes, new makeup, new electronics, whatever it is, if you charge that to your credit card and only pay the 2% minimum balance, then the total cost of that $1,000 purchase is $2,590.35. And it will take you 17 years and 3 months to pay it off. Do you think you'll still be wearing those clothes or using that makeup or playing that PS4 in 17 years? Probably not. But if you only pay the minimum balance, it's going to take you that long to pay it off. And look at how much longer it gets the more you go. $2,500. The total cost is $7,700. And it'll take you 30 years. That's a mortgage on a house to pay off just $2,500 by paying the minimum balance. $5,000 costs you $16,000 total and takes you 40 years to pay off. And an annual interest rate of 17% is very average for credit cards. It's actually kind of low. I see a lot of credit cards with 20, 21, 22% annual interest rate. So please, if you're opening credit cards, pay them off every month. If you pay off your previous month's balance in full the next month, you don't pay any interest. If you charge, great thing to do is to get a credit card. It's like a gas station, and charge your gas. So if you charge your gas to your credit card, whatever cash you would have spent on that gas, set aside somewhere. Put it in a piggy bank, put it in an envelope, set it aside, and then at the end of the month, go in and use that cash you set aside to pay off the gas. It's a great way to build your credit, and credit is important because the better your credit is, the lower rates you can get on things, so you save money by financing. But don't go crazy with credit cards. Please, I know it's tempting. There's so many things out there for you guys to get credit cards, and it's just a dangerous, dangerous thing. So this is the example that we're going to work with Abby buying the $8,000 dining room set. So she has the $8,000 dining room set, and she says that she's going to pay $500 a month. So we calculate the amount of interest that is. Her $8,000 balance outstanding you have to pay 1.5 interest each month because it's an 18% annual rate. So she's got to pay $120 towards interest out of that $500. The other $380 goes towards her balance. So her balance, she made a $500 payment, but her balance is only reduced by $380. So her new balance is $7,620. That is then the amount you use to calculate the interest for her second payment. $7,620 times 1.5%. She now has $114.30 due in interest. She pays $500, so the remaining $385.70 reduces her balance. Her previous outstanding balance minus the reduction, she's now owing $7,234.30. That is what you then use for payment 3 and follow the same process. So after 3 payments, she's paid $1,500 in payments, but her balance has been reduced by not even $1,200. She started at $8,000. She's at $6,842.81. So let's look at another way that credit card companies calculate finance charge is a percentage of the average daily balance. And the other one, in the previous example, we just looked at the previous total balance. Now we're looking at an average daily balance. So there are 6 steps to do. First, we need to calculate the daily balance or amount owed at the end of each day during the billing cycle. So the daily balance is calculated by whatever the previous balance was. It's increased by purchases and cash advances and decreased by payments and credits. A cash advance is a cash loan from a credit card company. So your balance increases with cash advances and purchases and decreases with payments or credits, returns, things like that. When the daily balance is the same for more than one day, multiply that balance by the number of days it remained the same. Add up the total of all of the balances. Divide the sum of the total balances by the number of days in the billing cycle. Always make sure to check the number of days in the billing cycle. It may not be 30 or 31 days. Next, we need to calculate the finance charge. Finance charge is whatever the rate is per month times the average daily balance. So like in Abby's example, her annual rate was 18%, so her monthly rate is 1.5%. So then the last step is to calculate the new balance. The new balance equals whatever the previous balance was, plus cash advances, plus purchases, minus payments and credits, and then add in the finance charge. So here is an example. Calculate the balance outstanding at the end of month 2. Use a U.S. rule given the following information. So she purchased a desk of $600, paying back $40 a month, and the charge is 2.5% interest on the unpaid balance. So this is calculating the finance charge using the previous month's balance. So month 1, $600 is due. So 600 times 0.25% interest is $15. Her monthly payment is $40, so 40 minus 15. Of her $40 payment, 25 goes to a balance reduction. 600 minus 25, her outstanding balance at the end of the first month is $575. Month 2, her outstanding balance was $575. Interest is 2.5%. So 2.5% times $575 is $14.38. Again, paid $40, so 40 minus $14.38, the reduction in balance is $25.62. $575 minus $25.62, her new outstanding balance at the end of the second month is $549.38. Let's look at calculating the average daily balance. In this example, we're calculating the average daily balance and finance charge from this information. We're told that the billing cycle is 31 days. The previous balance was $210. She made a payment of $50. She made a charge to Staples of $30. She made a payment of $10, and then took a cash advance of $60. We're also told that the rate is 2% per month on the average daily balance. So let's calculate the average daily balance. From 8/20 to 8/27, nothing happened. So there were 7 days the balance stayed at 210. So 7 times 210 is 1470. Then her balance became 160. She made the $50 payment. The 160 balance stayed for 4 days, 8/27 to 8/31. So 160 times 4 is 640. Then she made a charge of $30. So her balance went up to 190. The 160 previous balance plus her $30 charge is 190. That stayed for 5 days from 8/31 to 9/5. 5 times 190 is 950. Then she made a payment of $10. So her balance went down to 180. The previous balance of 190 minus 110, and it stayed the same for 5 days. 5 times 180 is 900. Now, how did I get 10 as my last days? Well, we know that 7 days have passed, 4, 5, and 5. So that's a total of 21 days we have accounted for here. We're told the billing cycle is 31 days. So 31 minus 21, our balance for 10 days was $240. 180 plus the $60 cash advance. So 240 times 10 is $2,400. Over here, we need to make sure that this adds up to our 31-day billing cycle. Add all of these numbers together to get 6,360. 6,360 divided by 31, we're told our average daily balance is $205.16. Now, $205.16 times our finance charge of 2%, our finance charge is $4.10 for the month. Another example, Molly Rowe has requested you calculate the average daily balance. She believes her average daily balance should be $877.67. So this example, notice we have a 28-day billing cycle. Her previous balance is $800. Then she makes a $60 payment, charges $250, makes a $20 payment, and then charges $200. So from 3/18 to 3/24 is 6 days. The balance is $800 for 6 days. 6 times 800 is $4,800. Then she makes the payment of $60. So 800 minus 60, the new balance is $740. $740 stays that way for 5 days. 5 times 740 is $3,700. Then she makes a charge of $250. The previous balance of $740 plus $250 gives us our new balance of $990. $990 stays that way for 7 days from 3/29 to 4/5. 7 times $990, $69.30. She then makes a $20 payment. So her balance goes from $990 to $970. And it stays the same for 4 days. 4 times $970 is $38.80. Lastly, nothing happens after her last charge. So 6 plus 5 plus 7 plus 4 is 22 days. We're told it's a 28-day billing cycle. So 28 minus 22, her balance stayed the same for 6 days. And her balance was $1170, the $970 plus the $200. 6 times $1170 is $7,020. Add all of these numbers together, we get $26,330. $26,330 divided by 28 days, her average daily balance is $940.36. She thought her average daily balance should be $877.67. The problem with her calculation is that she divided by 30 days instead of 28. She didn't pay attention to her billing cycle, so she got a lower balance. So she thinks that her interest is incorrect, when in fact it is correct. Her balance should be at $940.36. Jill bought a $500 rocking chair. The terms of her revolving charge are 1.5% on the unpaid balance from the previous month. If she pays $100 a month, complete a schedule for the first 3 months using the U.S. rule. So her beginning outstanding balance is $500. She pays $100. 500 times her 1.5% interest. Of that $100, $7.50 goes towards interest. $92.50 goes towards balance reduction. 500 less $92.50 is $407.50. Month 2, her new outstanding balance is $407.50. Times 1.5%, she has to pay $6.11 on interest. She pays $100, so 100 minus $611. She has a reduction in balance due of $93.89. $407.50 less $93.89. Her new balance is $313.61. Third month, $313.61 times 1.5% interest is $4.70. She paid $100. $470 that goes towards interest. $95.30 is a reduction in balance due. Her previous balance of $313.61 minus her reduction in balance due of $95.30, her outstanding balance at the end of the third month is $218.31.